Hello friends, let's start with another Ind AS in this revision videos of FRCA final, that is Ind AS 37, provision, contingent liability and contingent asset. This Ind AS we have studied in Inter as AS 29. Anyways, it's a completely theoretical AS, very important from reality perspective and not so very important from examination perspective. But still, it being a part of our curriculum, we are supposed to know it and know it nicely. Now, when we think about provision, the first thing that comes to our mind is provision for bad debt, provision for depreciation. Correct. So, chartered, let me make it very clear that this standard does not deal with any provision which is provision for decrease in the value of asset. It deals with provision in nature of liability. That means where the amount is payable. Provision for bad debt is not payable, it is reduction in asset. Provision for depreciation is not payable, it is reduction in asset. Provision for impairment loss is not payable, it is reduction in asset. So it does not cover provisions which are applicable for losses. Am I clear? Now, secondly, it is not applicable on executory contracts unless onerous. Now, what is executory contracts and what is unless onerous? Executory contracts means I have taken money today against which I am supposed to execute some work in future. So I have taken 5,000 from you and against that 5,000 I am supposed to give you benefit in future. So that's an executory contract. Correct. It is not applicable on that. Why it is not applicable? I'll tell you. Suppose executory contract I have taken 5,000, that is advance revenue. Correct. It's a liability, it's not a provision. But against that 5,000 ka revenue, I am supposed to incur some cost. Suppose the estimated cost is 4,000. Can I create a provision of cost of 4,000? No. You have received a revenue of 5,000 at advance revenue, so cash to advance revenue, you show it. When you execute the contract, whatever is the cost, you debit it, and then advance revenue to revenue, you do it and show it the revenue. Am I clear? Suppose I have taken advance revenue, so cash to advance revenue. Then in the year in which becomes a revenue, then revenue to advance revenue to revenue, cash to advance, advance to revenue. And in that year, whatever cost I have incurred, I will write cost to cash. So cost and revenue would be recognized in the year of occurrence, that is executory contracts. Now the standard says it is not applicable to executory contracts unless onerous. Now I have taken 5,000 revenue from you, advance revenue. Now against that I am supposed to incur that cost. Now what happens? When I took 5,000 rupees, it was fine. But down the lane, after few months, the situation changed and I found out that the cost to be incurred for executing this contract, cost to be incurred for executing this contract would be say 7,000. So there is 2,000 ka loss. So standard allows you to create this 2,000 ka loss ka provision. Why? Because the contract had turned onerous. Onerous means the onus of loss is on us. Am I clear? So if the contract turns onerous, that means the contract turns loss making, then the provision for loss should be created. On the contrary, the standard says that suppose you have taken 5,000 as revenue against which you are supposed to incur cost in future. You cannot create any provision for that cost. But suppose the cost exceeds the revenue, then you can create a provision for loss. In my example, advance revenue you had taken is how much? 5,000. Cost you are planning to incur is 7,000. So there is a loss of 2,000. But if you do not execute and come out of it, then the penalty for not executing the contract is 500. So chartered, you know that you have taken a revenue of 5. If you incur a cost, if you execute the contract, you have to incur a cost of 7. So ultimately there will be a loss of 2,000. But if you do not execute the contract and you come out of the contract, then the breach of contract ka penalty is 500. So it's better to pay breach of contract ka penalty or to execute the contract and incur loss. Sir, this is common sense. Obviously do breach of contract and pay a penalty of 500. Exactly. The standard says that you are supposed to create a provision of loss or penalty, whichever is lower. So I hope this point is clear. This standard is not applicable if other Ind AS applies for other standards which deal with liability. For example, financial liability ka provision, it is not covered over here. Employee benefits, when there is a provision which is not covered here. Deferred tax liability, not covered over here. Construction contract, maybe create a provision for loss, that is not covered over here. So there are provisions which are not covered over here because they are covered in their respective standards. Am I clear? So financial liability, employee benefit, DTL and construction contracts ka provision are not covered over here. They are covered in different standards. Am I clear? Yes or no? Yes. So first, it is not applicable to contract, it is not applicable to the contract which, it is not applicable to the provision for losses. It is applicable to the provision in nature of liability. It is not applicable on executory contracts unless onerous. And third, it is not applicable on those provision for which we have got other standards. Am I clear? Now, this standard basically gives us definition of all these three and how to recognize them and how to measure them. But this standard has a concept. I would request you to study AS4 before coming to this standard. AS4, rather Ind AS 10, that is events occurring after the reporting date. That there I say that there is a situation which leads to a transaction or event. That event should be recognized or should not be recognized, whether it's an adjusting event or non-adjusting event. So in that part over there, I discussed that there is this is a year end. There is a situation which leads to an event. This event is an adjusting event or non-adjusting, that we discussed. So this event is known as contingency, and this standard talks about those contingency. Ind AS 10 talks about those events, and Ind AS 37 talks about these contingencies. So first, let us understand this situation. Am I clear? If there is a situation which leads to a transaction, now this situation may be favorable, may be not favorable. This situation may lead to a event, may not lead to an event. Correct? If it leads to an event, it may be favorable, it may not be favorable. Favorable means you will receive money, unfavorable means you have to pay money. So if there is a situation which may be unfavorable or favorable, that means it will lead to a transaction which will give you money, favorable, which will not give you money, unfavorable. If it gives you money, that means money is receivable, then it is contingent asset and it should not be recognized in financial statement unless in nature of reimbursement. Now let's concentrate on this. So if there is a situation which would lead to a transaction because of which amount is receivable, then such amount should not be recognized in financial statements because it is a contingent asset. It is against conservatism principle, but it can be recorded if it is in the nature of reimbursement. Now I'll give you simple example. You have heard of insurance? Yes. Now there are two types of insurance. One is known as loss of stock or asset, and one is loss of profit. So loss of asset I understood, loss of profit. Suppose chartered, I had a shop where I was dealing with goods. That shop got fire. So assets were lost immediately. But the shop also caught fire, so assets were lost, goods were lost, because of which there will be a renovation period. Correct. Now let's assume this is a renovation period. This renovation period lasts for 3 months. In this 3 months, definitely due to renovation, either there will be no sales or your sales will dip. Correct. If your sales is not there or your sales will dip, that means if your sales decreases, your profit decreases, and you want to recover that profit. So you insure that profit, and that policy which insures this kind of profit is known as loss of profit policy. So this is basically covering your profit. Correct? So this is one kind of policy. Another kind of policy is loss of asset. That means there was an asset for which you have incurred money. Against that, the asset has gone and you are recovering money. So can I say money is a compensation or reimbursement of loss of asset? You had plant and machinery of 10,000. You lost it. Against that, you are getting a claim of say 8 rupees. So can I say 8 rupees is nothing but reimbursement of plant? Yes. So according to standard, loss of asset policy can be accounted even if you have not received the money. But loss of profit policy cannot be accounted because this was purely contingent asset, but this was reimbursement. Loss of asset ka policy, say whatever insurance claim you are going to receive, that is reimbursement for that asset. That can be recorded, but loss of profit policy is your gain. That cannot be recorded because it's a contingent asset. Another example. Suppose chartered, I told that I will buy oil at 32. I entered into a future contract to buy oil after 3 months at rupees 32. So I am assuming the price of oil will rise. So I entered into contract. Commodity market derivative mein I entered into contract to buy oil at 32 rupees a liter. Now granted the oil price started falling. 31.75, 31.5, 31. So I entered into other contract that I will sell oil at the rate of 30. I will sell oil at the rate of 30 after 3 months. Same period mein both the contracts will mature. Now chartered, if the contracts reaches 35, that means you will buy the oil at 32, sell at 35. You gain 5 rupees. But if the oil price dips to 29, so goes to 35. So 35 mein over here you purchase at 32, sell at 35, you gain how much? 3. But over here, this is purchase wala contract, this is sale wala contract. But over here, you purchase at 35 and you sell at 30, so you lose how much? Losses 5 rupees. So your net loss will be how much? 2 rupees. Correct? Now the price of the oil becomes 29. So you buy at 32, sell at 29. So there is a loss of how much? 3 rupees. But you buy over here in the second contract, you buy at 29 and sell at 30. So you gain how much? 1. So there is a loss of how much? 2 rupees. So can I say this is a hedge contract? This is a contract to hedge your loss because you are expecting the price would continue to fall. So if the price of the oil is falling, that means chartered you have got 2 contracts. One may you will receive money, the other may you will, if the price of the oil is falling. So one may you are supposed to pay money, but one may you are supposed to receive money. In price becomes 27, so 5 rupees you are supposed to pay. So you create a provision of 5. But against this, you have a contract where 27 may you will purchase and sell at 30, so you will gain 3. So can I say this gain would reimburse your liability? So I hope you understood. You entered into contract to purchase oil at 32 and sell oil at 30. Price of the oil becomes 27. So purchase wala contract mein kya hoga? You will purchase at 32, sell at 27. So loss 5. इस वाले कॉन्ट्रैक्ट में क्या होगा? You sell at 30, buy at 27. You buy at 27, sell at 30. That means 3 gain. So this gain is your contingent or reimbursement. You will set off this gain against this liability because this is payable, this is receivable, but this receivable is for this payable only. So this 3 rupees is known as reimbursement, and that is what the standard says, that if there is a situation which would lead to a favorable or unfavorable transaction, that means amount receivable or amount payable. Amount receivable may it shall not be recorded because it's a contingent asset, provided it's a reimbursement. Reimbursement ka 2 example I gave. So any wagering agreement you enter, any speculation deal you enter, or any hedging deal you enter to cover your loss. So that hedging deal will give you money and this hedging deal will give you payable. So payable के against में you record the receivables, because that receivables you will use to repay this receivables you will use to repay liability. And if you very roughly remember, if you have done employee benefits में there is PVDBO, present value of defined benefit obligation, that is your obligation which you are supposed to pay, and chartered there is a plan assets. So this plan assets are investments which you will sell, get the money, and you will pay to your employees. This plan assets you purchased at 10, cost is 10, but market value is 12, so standard says you are going to record at 12. So people start asking, this is against conservatism. No, this is not against conservatism. This 12 rupees is reimbursement towards this PVDBO, and that is why standard allows plan assets to be recorded at fair value. So this reimbursement is allowed, chartered. Okay. So few things are clear. This standard deals with provision in nature of liability. This standard does not deal with provision in nature of losses. This standard this standard does not deal with executory contract unless onerous. Third, this standard does not deal with those provisions which are catered by other standards. And now let's understand the concept of this standard. The concept starts with situation and a transaction. So this standard basically deals with the situation which occurs before the balance sheet date. Should this situation be accounted or not accounted? This situation could be called contingency. If this situation can be favorable and you're going to receive money, and or this situation is unfavorable where you might have to pay money. If this situation is favorable where you will receive money, then it shall not be accounted because it's a contingent asset against conservatism principle. But if this receivable is like a reimbursement, then it shall be accounted, for which I have given you 3 examples. First example was of loss of profit, loss of asset. Second example was of derivative contract. Third example is of plan assets. Am I clear, chartered? Now, divisible, if it is unfavorable, that means you are supposed to pay amount. It is unfavorable, chartered, that means you are supposed to pay amount payable. Should this amount payable be recognized in the financial statement? Yes or no? Yes, you are supposed to recognize this if two conditions are, if it satisfies 2 conditions. This amount payable should be recognized in financial statement if it satisfies 2 conditions. First, it should be probable. Second, amount can be estimated. Probable means probability of paying is more than 50%. And the amount you are supposed to pay, you can estimate that amount on a reasonable basis. So chartered, if both the conditions are satisfied, that the event is probable and the amount payable can be estimated, then you are supposed to recognize in financial statement as provision. But understand, if it is probable and amount can be estimated, then you can record. But if it is possible or amount cannot be estimated, you will not recognize in the financial statement, you will recognize it as footnote, as contingent liability. So chartered, understand. Suppose situation is amount, there is a situation which will lead to amount payable. The chances of amount payable are 70%. Amount can be estimated, yes. Then, so 2 conditions need to be satisfied. Chances of occurrence should be more than 50% and the amount can be estimated. Then you will recognize it as provision. Second में 2 situations. Chances of occurring 70%. So is it probable? Yes. Amount can be estimated? No. Contingent liability. Suppose chances of occurring are 30%. Is it probable? No. Can the amount be estimated? Yes. Contingent liability. Second, can you estimate it? Chances of occurrence, chances of payable 30%. Can you estimate it? No. Contingent liability. So whether it is possible or amount cannot be estimated, either one of the condition is satisfied, then it will not be treated as provision, it shall be treated as contingent liability. So over here it is probable. So possible wala condition is not satisfied. But amount can be estimated, no. Either into may say one condition is satisfied, then it is contingent liability. Am I clear? This was your first basic principle. Now let's see and understand what does the situation, contingency may lead to an event either favorable or unfavorable. Amount receivable, contingent asset, should not be recognized in financial statement unless in nature of reimbursement. Amount payable should be recognized in financial statement, yes, if it is probable and amount can be estimated, then it should be recognized as provision. Amount amount payable, no. Why? If it is possible, that means probability of payable is less than 50%, or amount cannot be estimated, then it should be recorded as contingent. So over here you have to fulfill any one condition. Is it possible? No. Can the amount be estimated? No. Any one question answer. Is it possible? Possible. If I say is it possible? No, that means it is probable. That means if a probability is less than 50% is possible. So if I say is it possible? No, that means probability is more than 50%. That means this condition is not satisfied. Amount cannot be estimated. Yes. So this condition is not satisfied. Second condition is satisfied. It will not be recorded as contingent liability. Am I clear? So if the chances of occurrence are more than 50%, but amount cannot be estimated, contingent liability. Chances of occurrence are less than 50%, but amount can be estimated, still contingent liability. I hope you understood the fair difference between and or. Yes. Now charted concept 2, that is obligation. So you understood about the situation. Now we are over here. Amount receivable to done. Amount payable में आते. Amount payable में there are two possibilities. Either it can become provision or it can become contingent liability. Now let's check. So whether obligation is possible or probable. Now obligation का मतलब क्या होता है? Obligation means liability to settle. It can be legal or constructive. Obligation to pay or obligation to settle. It can be legal or constructive. Obligation means you are supposed to give something either in cash or kind. It can be legal or constructive. Legal matlab there is a document. Constructive means because of past practices. You buy goods from me and I have written in the bill, if the goods are returned, I will refund you the money. Legal obligation. But in bill it is not written, but in my shop it is printed. If the goods are returned within 10 days, the money will be refunded without any questions being asked. So it's a constructive obligation. So we'll check whether obligation exists or not. Obligation is 4 situations: certain, probable, possible, remote. Certain, probable, this is English terms. Certain, probable, possible, remote. Certain means yes, it will occur, 100%. Probable means more than 50%, less than 100%. Possible, more than 5%, less than 50%. Remote, less than 5%. So certain means sure, 100%. Probable means more likely than not, 50%. Possible, not more likely than not, less than 50%. Remote, very rare, less than 5%. So first we check the chances. So to find out if probable, is obligation probable? Amount payable means obligation. Amount payable means obligation. Obligation either in cash or kind. Is the obligation probable or is the obligation possible? So we first we understood what is obligation, and then we understand the degree of obligation. Does obligation exist? The first question, sir, what is obligation? Obligation is amount payable. Sir, what kind of payable? Payable because of legal binding or constructive binding. Fair enough. So does obligation exist? Yes. To what degree? Certainly, probably, possibly, remote. So if I say probably it will rain, that means chances of rain are more than 50%. Possibly it will rain, that means chances of raining are less than 50%. remote chance, remotely it will rain. That means chances of raining are less than 5%. Am I clear? So these words, probable and possible, are used generally in reality interchangeably, but they too have a different meaning. When I say probably, that means there is a high chance. When I say possibly, that means there are low chance. Is he coming to Bangalore? Probably. Probably. That means yes. Possibly. Maybe. Are you understanding? Yes. So after you decide that obligation ka degree, then you decide amount payable. Amount payable can be two part, certain or uncertain. If it is certain, to baat hi khatam. If it is uncertain, then you ask two questions. Can it be estimated or it cannot be estimated? The answer can be yes, it can be estimated. No, it cannot be estimated. Now you combine these two. Certain, liability. Certain, uncertain but can be estimated, provision. Certain, uncertain and cannot be estimated, contingent liability. Because contingent liability में you are supposed to fulfill only one condition. तो provision के लिए this two and this होना चाहिए. This two and this. Liability के लिए this. Am I clear? Now rest all is contingent liability. Possible के साथ anything is a contingent liability. और इसके साथ anything is a contingent liability. I hope you understood. So certain, liability. Probable and certain. Probable and certain, provision. Probable and uncertain but can be estimated, provision. Probable but cannot be estimated. Shit. Probable and cannot be estimated, contingent. Possible and certain, contingent. Possible and estimated, contingent. Possible and cannot be estimated, contingent. So possible के साथ any three is contingent. Cannot be estimated के साथ anything is contingent. Am I clear? So first you have to decide situation, receivable or payable. Payable, that is obligation. Obligation is because of legal or constructive, anything. Now check the degree of obligation. Certain, uncertain, certain, probable, possible or remote. After you check the degree of obligation, check the amount. Certain, uncertain but can be estimated, uncertain and cannot be estimated. Then you match and decide whether it's provision or contingent liability. Am I clear? Yes or no? So step one, check amount receivable, payable. Receivable में check contingent asset or reimbursement. Contingent asset you will not record. Reimbursement you will record. Amount payable, check. The obligation exists or does not exist. Exist. Then check degree of obligation. After checking the degree of obligation, check estimation of amount. And after all these three, check whether it is, decide whether it is provision or contingent liability, or it shall not be recorded in books of accounts or financial statements only. I hope it is clear. Now it will make a sense. What is the definition of liability? Liability is a present obligation arising from past event, and settlement of obligation will result in outflow of economic resources. Legal, constructive, obligation. Provision. Provision is a liability of uncertain amount or timing. That is present obligation arising from past events, and outflow of economic resources is probable. And it will, settlement of obligation will result in outflow of economic. That means amount payable is certain. Obligation is certain, amount is certain. Over here, obligation is certain, outflow of resources is probable. It may or may not. Amount can be estimated reasonably. So obligation is certain, obligation is probable, and amount is estimated. Okay. Provision shall be recognized as a liability in financial statement. Very good. Amount of provision. There are many possible outcomes. Then calculate expected by using probability of each outcome. Probability into cash flows. That is 70,000 you are supposed to pay, and outcome is 70%. Chances of paying is 70%. Then 49,000 ka probability. You amount estimated 70,000 you have to pay. Chances of payment are 70%. Then create a provision for 49,000. Correct? If there is one possible outcome, then consider entire amount. One possible outcome, then consider entire amount. There are many possible outcomes. Chances of payment are 50%, 60% chances you are supposed to pay 80,000. Then 60% into 80,000, 48,000. Am I clear? Now, chartered, there is a case. If you win, you don't have to pay. If you lose, you are supposed to pay. Then chartered, loss. If you win, then the amount is receivable. Forget it. There are 10 cases. 3 chances of winning, 5 chances of losing, 2 chances of losing. So this is losing with high amount, losing with low amount. This is chances of winning are whatever percentage, I am not in. Chances of losing with high amount 60%. Chances of losing with low amount 30%. So every time you are supposed to pay each case for 1,20,000. So 60% of 1,20,000 into 5 cases. Low amount is 30,000. So 30,000 into 30% you are supposed to pay into 2 cases. Am I clear? So if there are more than one possible outcomes, you multiply with the probability factor. ये समझा के नहीं? Correct? So there are 10 cases. I told you 5 win, 3 loss with high, 2 loss with low. This is 60% chances, this is 30% chances. Each case may you are supposed to pay 12 rupees, 8 rupees. So 60% of 12, 3.6, sorry, 60% of 12, 7.2 per case into 3, that is the amount payable. 30% of 8, 2.4, 2.4 into 2 cases, 4.8. This is the total amount of provision you will create. Am I clear? Yes sir, no sir, yes sir. Now chartered. So you understood provision should be recognized as liability, and how will you measure the provision? If there are more than one outcome, probability into how much you are supposed to pay. If there is only one outcome, then entire amount should be recognized. Correct? If expenditure is to be incurred after 1 year, then provision should be recognized at present value. That we have studied in, suppose you are supposed to pay after 5 years. You are supposed to pay, you are supposed to create a provision, you are supposed to pay 50,000 after 5 years. Correct? So it present value it, and say suppose today ka value is 30,000. So today you will record it, create a provision of 30,000. Then every year provision will increase. Finance cost to provision, interest 10%. 3,000, 3,000. Next year again finance cost to provision 10%. 33, 3,300. So that way you will go on doing. Every year you will unwind the provision. Unwind means compound the provision. Am I clear? Expenditure is to be incurred after 1 year, then provision should be recognized at present value using pre-tax discounting rate. Pre-tax discounting rate, not post-tax. Am I clear? Why pre-tax? Pre-tax ही लगेगा ना, because that amount is before taxation. Charge interest on unwinding of provision as finance cost. Unwinding of interest means compounding of interest on liability. If there is a risk that actual outflow would be more than the expected present value of outflow, then expected outflow add risk premium is equal to the amount of provision. That means you are assuming that actual outflow would be 20,000, but expected present value of outflow is 15,000. Then you add a risk premium. You understand? You are expecting that you will spend 50,000. After 2 years, your provision stands at 33,300. Now you believe यहाँ पर chances that you will spend 60%, 60,000. That means how much extra you will spend? 20%. तो 20% premium यहाँ पे add कर दो. 20% is 6,660 add कर दो. 39,960 का you create a provision. So after few years you re-estimate, you believe that the outflow will be 60,000. Then you increase the provision amount. Am I clear? Yes, no, yes sir. If the risk that actual outflow would be more than the expected present value, then expected present value add risk percentage. Provision should be reviewed at each balance sheet date. Provision should be reviewed at each balance sheet date. Your provision might increase, your provision might decrease, and it shall be considered as change in accounting estimate. Your estimate might change, and hence it should be given prospective effect. And if you believe you have created a provision for bad debt at 12,000, correct? Next year you believe that there will be no bad debt, reverse the provision. You believe that the bad debt will be 8, so increase the provision. You believe that the bad debt will be 2, then decrease the provision, and that would be prospective change. If an entity can avoid any expenditure in future actions, any expenditure by its future action, then no provision is required on such expenditure. That means you have created a provision for repairs, which you can reverse it, then don't create provisions. Future operating cost like overhaul or inspection or operating losses, etc. That means any loss, for example, you have created provision for bad debt, and if you believe that bad debt can be over, provision for bad debt, provision for repairs, but you believe that if you take care of your asset by doing a regular maintenance, then repair cost will not be incurred, then you cannot create provision for repairs. Then you should not create provision for repairs. Is it recommendatory or mandatory? Recommendatory. Provision, if an entity can avoid any expenditure by its future action, then no provision is recognized on such expenditures. Am I clear? You can avoid future expenditures by taking actions today, or any actions during the course of the time you can save. Like these are operating losses now. That means your staff is not working optimum capacity. Your machines are not running according to optimum capacity. So you want to create a provision for loss. First of all, provision for loss is not covered over here. Now, for example, you have an asset which you are supposed to have taken a lease. You have taken an asset on lease, and after 10 years you are supposed to return that asset. So you have recognized in your balance sheet as ROU, right to use the asset. So when you are using the asset after 10 years, you are supposed to incur DSR. Which expenditure? DSR, decommissioning and site restoration. But you are sure that after 10 years the asset will stay with you only. That means you don't have to incur DSR. If you don't have to incur DSR, do not create a provision for DSR. Am I clear? Onerous contract, that I have already explained. Correct? Uska example is there. Restructuring. It is a plan to change the scope of business. It is a plan to change the scope of business or the manner of conducting business. Plan to change the scope of business or manner of conducting business. Scope of business means you are basically talking about a segment, which you used to call it in your intermediate as internal reconstruction, closure of division or sale of division. Revamp, shut down or sale. Revamp, shut down or sale. In all the three situations, you might have to incur expenditure. You are planning to internal reconstruction, you are planning to shut down, you are planning to sale. For all these three, you are going to incur some expenditure, which is known as reconstruction cost. Provision for reconstruction cost should be created or should not be created. Standard says that you can create a provision for reconstruction cost, provided entity has a detailed plan that how will you do internal reconstruction, what is the process of closure, or the method in which you are going to sell it, and the entity has raised a valid expectation for restructure by announcing the plan. They have announced the plan of restructuring and they have a plan of restructuring. Then provision for restructuring cost can be made, else you cannot make it. I repeat, suppose an organization is a planning restructuring, that means internal reconstruction, shutting down or selling of a division. So for that you will incur some cost. Correct? Internal reconstruction हो या कंपनी बंद करनी हो या कंपनी बेचनी हो, in all the three situations you will incur some cost, that cost ka provision should be created, should not be created. The standard says you can create the provision provided there are two conditions should be fulfilled. First, the plan should be announced and the plan should be ready. Correct? Then the provision can be created. Moreover, provision for restructuring cost include only direct expenditure arising from restructuring, staff termination, compensation to customer, lease termination, etc. Relocation cost, retraining cost of employees and impairment loss on assets are not considered in amount of provision. That means direct cost because of restructuring, restructuring you will terminate the staff, VRS scheme payment karna hoga, compensation to customers karna hoga, you have to terminate your lease. So there is a cost for that. All that ke liye whatever is there. So direct impact for internal reconstruction, direct impact of closure ke liye you can create a provision. But because of shutting down your or relocating or again training, that is all not considered. So try to understand. Internal reconstruction when you are planning a new asset will come. So new asset ke liye I will require training. Whatever is required to be done to do internal reconstruction, you can create a provision for that. Whatever you will do after internal reconstruction, for that provision you cannot make. For internal reconstruction, you will close the lease, create a provision. For internal reconstruction, you will terminate the staff, create the provision. After internal reconstruction, you will shift your place of work. You will retrain your employees. You will check asset ka impairment. That is all after reconstruction. So for reconstruction cost allowed. After reconstruction cost ka provision disallowed. So again, let me sum up. Can provision for reconstruction cost be created? So first doubt, what is reconstruction? Is reconstruction sure? Is the plan ready and the plan has been communicated? Yes. Then you can create provision for direct cost and not the cost to be incurred after reconstruction. Am I clear? Reimbursement, that we have already discussed. Reimbursement shall be recognized as a separate asset in the balance sheet. Provision, expenses and reimbursement income can be presented by netting off. Reimbursement shall not exceed the provision amount. That I explained now. Forward contract up, loss or profit. Sell gold at 30, since the price started rising, company purchase a forward contract to sell at 35. So reimbursement I have explained. Now chartered provision में what and all you are supposed to understand. एक बार provision को let's recap and then move ahead. What is provision? You understood. Correct? Obligation is certain or probable and amount is uncertain but can be estimated. Am I clear? Yes, no, yes. Where to recognize provision? Provision shall be recognized in liability. How much provision to recognize? If there are more than one outcome, then probability into cash flows. If there is only one outcome, entire amount. Correct? If the amount is payable after 1 year, then you should discount the provision and then record at pre-tax rate. Am I clear? And every year you should unwind, compound the provision with interest, that should be charged to finance cost. Correct? If you expect that the outflow today would be more than the present value, then increase the present value by doing a risk premium. Correct? Okay. Thereafter, provision should be reviewed at every balance sheet date. You might have to increase the provision, decrease the provision, or reverse the provision allowed. Am I clear? Now chartered, if entity can avoid future expenses by doing some actions, then entity should not pay provision. What is provision? Yes. Where to recognize the provision? Liability. How much provision to recognize? One outcome, more than one outcome. If provision is after 1 year, pre-tax discounting rate. Unwind as financing cost. If you feel the present value, your present value of the provision, the actual outcome will be more than the present value of provision, then increase the amount of provision with risk premium. If and provision should be reviewed at every balance sheet date. It may increase, decrease, or reverse. Now, if there is a future expenditure for which you have created a provision, but you can avoid that future expenditure by doing something, then you will not create the provision. Am I clear? Then chartered three special things: onerous contract, reconstruction, and reimbursement. Am I clear? Yes. After that, chartered, you have got contingent liability. This we had already discussed. Possible obligation, outflow of economic resources not probable or amount cannot be estimated. Recognition, contingent liability should not be recognized, but it should be disclosed in notes to accounts. Contingent asset, possible asset arising from past event. Inflow of economic resources is probable but not virtually certain. Disclose in, but not virtually certain. Chances of coming is 100, more than 50%, but not certain. So there are chances of you getting the money. More than 50% chances of getting money. Do not record. Inflow of economic resources not probable. Not probable. Then no disclosure is also required. If chances of receiving the money is not probable only, that means chances of receiving money are less than 50%. Then not to disclose as contingent asset only. Correct? Yes, no. Yes, sir. Now chartered. So that was your end of this standard: contingent liability, provisions, and contingent asset. Am I clear? Go through this video in a 2x speed. Believe me, it will be really very good for you to recap the things and put the things in one perspective, in one dialogue. Thank you so much. See you in the next video with the next standard. Till then, bye-bye.